Joining us is Jing Ulrich, the chairwoman for Global Markets China at JPMorgan Chase. Many thanks indeed for coming in, Jing, today.
Thank you for having me.
Now, before we go to the EU, let's discuss Chinese trade. Now, 2008 peaked at 300 billion. This year said to be half that. I mean, how concerned should investors be about the Chinese trade situation, exports falling, all because of Europe, it would seem?
Well, that's right. We're seeing China trade surplus shrinking in 2011. As a matter of fact, the net surplus this year will be under 3% of GDP. So that's coming down significantly from 2007, 2008. So basically, we're seeing the Chinese economy becoming less reliant on exports for its growth. So that's a positive news. But on the other hand, the negative news is that we're losing one important driver for GDP in the new year. So therefore, most of the growth has to come from domestic sources.
Now, the concerns also are food prices, aren't they?
Yes, that's correct. In terms of food, we're seeing CPI inflation, of course, coming down. That's encouraging. But in the new year, the central government clearly is shifting its policy away from fighting inflation to really boosting growth.
Do you think inflation has peaked, Jim, now?
Absolutely. Inflation actually peaked in July. So in August, September, October, for the last 4 months, the inflation basically has been gently moderating. In the new year, we're expecting inflation to go to 3.7%. That's much lower compared to 2011.
We had Namura on this morning, the chief China economist, talking about how growth will be below 8% next year, one of the most negative forecasts. He's concerned about a trade deficit and also, in fact, about the property slowdown will be quite dramatic, he said. Do you think that's right?
Well, for the whole year of 2012, we're forecasting GDP growth to be around 8.2%. Now, the first quarter GDP growth may actually dip below 8%. Our forecast is 7.6%. What this means is that the central government needs to introduce more policies to rejuvenate the economy. Across industries, from manufacturing to exports and even the consumer sector, we are seeing some moderation these days, and that deceleration may continue into the new year.
Some moderation, therefore, a soft landing as opposed to a hard one?
Well, we think the current situation will lead to a soft landing. A hard landing in China basically would mean that growth rates drop to 4 or 5%. We think that's very, very unlikely given the current circumstances.
Let's talk about the EU Leader Summit. Successful or another big disappointment?
Well, I think the market has been disappointed because there was a great deal of anticipation of some concrete steps being taken to resolve the European debt crisis. However, I don't think anything significant has really come of it because reaching a fiscal union is easier said than done. Now the question is, what can China do to assist Europe? We have to look at China's own economic situation first. Look at China's per capita GDP, it's $4,500 US. The European countries, of course, are much richer. So for China to quote-unquote rescue Europe is a political non-starter. However, China does have significant investments that it can make in Europe, provided there are significant investment returns associated with those investments.
That's a big one, isn't it, Jim? Because provided there are significant investment returns, what return is there for China?
Well, you know, China could be investing in some of the infrastructure projects in Europe, which will yield long-term returns, of course. And if China invests in European companies, European banks, and also the sovereign debt of European countries, clearly China would expect some level of return rather than just helping or rescuing Europe with no returns.
It's a hard sell, isn't it, for Chinese people to try and bail out or help Europe when, of course, Germany is not that keen to help Greece anymore and the ECB won't buy bonds.
Well, clearly, the ECB may have to start buying bonds in the new year, right? So far, they've been reluctant to do so. But is the ECB the buyer of last resort, like the Federal Reserve Bank is, right? For example, the Fed in the U.S. has been buying, government treasuries in the last couple of years, the QE2, et cetera, right? But ECB hasn't started doing that. In the meantime, China is looking at the European situation very closely because, after all, EU is the single largest market for Chinese exports, which are slowing right now.
We've seen the shipments, in fact, on that point, a quarter of what they were back in July and August. And also German shipments down, actually falling by 1.5%.
I know, clearly the slowing European economy is affecting the entire 17-country union and also the peripheral countries as well. Chinese exports in this last month slowed down to under 14%, which is actually quite unprecedented because it's the lowest export month in the last 3 years.
Jing, behind closed doors, the Chinese leaders, are they just scratching their heads thinking, what are these people doing? They've had so many meetings over 2 years and nothing's been accomplished.
Well, I think that sentiment may be shared by worldwide leaders. It's not just China, and also business leaders. Everyone is watching with a great deal of interest on what kind of fiscal union how that might evolve. And in terms of monetary policy as well, the ECB may have to cut rates again in the next couple of months to rejuvenate growth. But at the end of the day, the European country needs to rein in spending, cut deficits. Basically, that will imply slower growth for the coming few years.
Let's talk about the breaking news that we just got a few minutes ago. Did you hear about Haitong pulling their $1.7 billion share sale? This according to 3 people familiar with the matter. Does this surprise you at all?
Well, towards year end, we've had quite a lot of IPOs. While I cannot comment on specific issues, I think the market now is digesting some of the year-end IPOs. This also is an indication that the market actually is rather weak because of the outlook for the economy, and the investor sentiment remains quite cautious, I must say, at this juncture.
Yeah, I just wanted to know why these companies chose year-end to try to list. I mean, they knew they were coming up against a crunch, right? Time crunch. And also, there's a lot of volatility in the markets right now.
Well, actually, there are more IPOs in the mainland China compared to Hong Kong. This year, as you know, is a rather tight race between Shanghai and Hong Kong in terms of the IPO proceeds. We will see by year-end which exchange wins out. But clearly, companies still have a lot of needs for financing in the year-end. Bank credit has been tight, so they're finding ways to raise money, whether through equity markets or through bank loans.
Do you think it's a bit of a desperate rush, though, all these IPOs, all in the last month?
Well, I'm not sure whether it's desperate. In some cases, there has been good demand in the consumer sector, in the luxury retail sector. Investor sentiment has been okay. However, in heavy industries, in some of the sectors that are very exposed to the weakening economy, I think investors are actually taking a second look whether they should be going out to purchase these shares towards year end.
You know, the Hong Kong Stock Exchange has been so active in courting foreign listings here. I wonder as we go into next year if that pace will continue or if we may see some pullback in that as well.
Well, you know, the Hong Kong market has really been globalizing and internationalizing because for the past many years, Hong Kong has been attracting all these large mainland companies coming to Hong Kong to list, the banks, the oil companies, the telcos. In the last couple of years, I think the Hong Kong Exchange has made a concerted effort to attract listings from Mongolia, from London. So I think that's going Russia as well. So Italy. I think that's going to be an ongoing trend because this pool of capital in Hong Kong is very significant. You've got a lot of wealth managers here. You've got a lot of retail investors who are interested in participating in companies, not just in Hong Kong, China, but also global companies.
There's no volume right now. People have already shut their books to go home for Christmas at this point. Take a look at how much a trade is actually being done day in, day out.
Yeah, well, that's true. You know, towards the end, this is a general phenomenon that we see year after year. Especially this year, we have a weakening economy. We also have the European situation dragging on into the new year. So investors basically are sitting back to say, look, we will see how the situation pans out before we commit significant capital.
Jing, I want to talk about the European situation that you just highlighted. Clearly, banks in Europe are in a very challenging situation. If you take a look at their balance sheet on the asset side, they're dealing with these sovereign debts going sour. On the liability side, they're trying to raise more capital with respect to this Tier 1 capital ratio. How can these banks reconcile their balance sheet? And do you think that there are going to be further asset sales going on to really get that needed cash?
Absolutely right. You know, we are seeing European banks trying to shrink the size of their balance sheets to deal with the problem you just described. So this basically means they're pulling back from financing overseas operations, from commodities trades, for example. So that's going to leave a vacuum for some of the areas in the world economy. So we're seeing slowing growth as a result of the reduction in financing from European banks. Clearly, the region that will be most affected directly is Europe, but this has ramifications globally as well.
Well, that begs the next question, which is if they reduce their number of if they try to really let go of their asset sales, then to what extent is that going to be China and Asian economies coming in and swooping in all of these asset sales that are really left on the table?
Well, there are lots of assets for sale in Europe. There may be more in the new year. But we're seeing quite a lot of caution on the part of Asian investors because they want to know what they're getting into. They want to know what the returns are if they were to invest significant amounts of money. In the case of China, with $3.2 trillion US of reserves, with a lot of powerful state-owned enterprises who are cash rich, they're looking at the situation very carefully. But no one so far has made any specific commitments on how much China might invest.
What about a banking crisis beyond, far bigger than Lehman's next year?
Well, you know, that's something that people don't want to see happen, but frankly, it could happen, just like what people are looking at for the new year. I mean, some people are even anticipating possibly a breakup of the Eurozone, a breakup of the currency, right? So, you know, nothing is impossible. So some companies are actually looking at contingency plans if the worst case scenario were to unfold.
Were you talking about a banking crisis in Europe or in China? Because we had that survey,
I think in
remember,
Europe,
global investors?
certain banks, no one knows what's going on. There's uncertainty that prevails, the exposure to Greek debt, Italian debt, the German banks, the French banks, etc. That's the...
Yeah, you're seeing some of the rating agencies.
Yeah.
Well, absolutely. This is it's a worldwide phenomenon. Some of the rating agencies have downgraded the entire European region, the 17 countries, right? So one wonders, you know, how this might affect the U.S. banks and Asian banks.
But we also had this global investor survey that said there's going to be a 61% chance of a banking crisis in China as well in the next 5 years.
I think with regard to China, we need to look at a couple of things. The financing of the Chinese banks largely is through retail channels, right? In the Chinese banking sector, looking at the specific deposits, we have 75 trillion RMB of deposits, which are liquid. Because China has a closed capital account, this money has nowhere to go. This money basically is there in the banking system. Nearer term, I would say the chances of a banking crisis in China are very low. In the medium to long term, we need to see what reforms the Chinese regulators will undertake to push the bank towards more a commercial orientation rather than under the protection of the state.
Okay, Jing, thanks for dropping by.
Thank you very much for having me.
Jing Ulrich.
Happy holidays, everyone.
Thank you.